If we are headed into a recession, whatever type of recession it is, bonds are the place to be?
I think so. And we have a nice setup coming into 2023, thanks to what happened in December, really. So I've called it a clawback in one of our recent publications, and, you know, claw like that. And think about your fingernails.
Yeah. Really dig in.
Digging in,
but also scraping a little bit. So the idea here is that the coupon is more attractive than it was a year ago. So a year ago, the Fed wasn't hiking. They were projecting at most 325s. In the end, they did more than 3 times that, almost 4 times. So we've got some coupon in bonds now. So your total return is going to be boosted by the fact that you've got some yield, you've got that coupon. And that's what bonds are supposed to do. They're supposed to be boring. They're supposed to give you some ballast, some income. The capital gains and all this sexy stuff, that tends to be for the crypto and the tech stocks and what have you. Bonds are supposed to be boring. So in a way, bonds might now be playing that role in the portfolio. And I think that people are now talking about the 60-40 portfolio in more favourable terms than they might have been a year ago.
That's if inflation's going to play ball this year.
Yeah.
What do you think?
Yeah. Well, if 2022 was about inflation, then this year it's going to be about the transition to growth risks, recession, this kind of thing. So inflation is very much in the price. And look, if the Fed is projecting numbers to year end that are still quite high, they've got a 3 handle on their key forecast. I think the minutes will tell us some more of that tonight about that discussion. But the point is, most people know where it is. Inflation is very much in the rear view mirror. Now, in your setup just then, you mentioned commodity prices. It looks like you're going to get a big disinflationary impulse coming from that side of things. The key is wages, and that's what the Fed's worried about. Everyone's worried about. They're high and they're sticky, but a recession will take care of that. I mean, that's I hate myself for saying it, but that's the reality.
How do you anticipate then central banks to react to any recession, a forthcoming recession?
Well, policy acts and works with a lag, and so it all sounds too clever by half to be able to say. So just now, Bill Dudley said it. So the Fed is inducing this recession, so then they can relieve the pressure of the recession as well. Well, yes, they can, but with an 18-month lag. So that's just a bit. It's a bit too nuanced, this. So something could go wrong. Markets are about tail risks, not just the base case. So most people will come on the show, give you their base case, but you really need to flesh out the tails on either side of that. And it looks to me that with all the leverage in the system, we learned a lot in 2022 about the fragility of the global economy. I mean, pick your example. What was it, the UK pensions mess, or was it crypto? I mean, there's going to be more of this. There's going to be a lot of tension as we have the refinancing risk being exposed of huge pools of debt. So I suggest that it's probably tipped more towards the left-hand side of the distribution, so towards lower yields, not higher yields. And we've been setting up for higher yields for the last year. Now we've got them. It's going to take a real upside inflation surprise for us to get rates moving justifiably above 5 in the US, towards 6, as some people have been calling it. That is a tail risk that I would say has a lower probability than the fact that they arrive and start to look at the other side, to the left-hand side.
So where in the curve do you focus on the most? Do you focus on shorter end, long end?
Trying to fade the inversion has been a bit of a difficult one. So many people saw the curve invert, tried to position for steepening, they just didn't work. At some stage, it is going to be the right trade. And you have to take a lot of pain for this, but I think that there's a lot more value in the belly of the curve, and that's because of this inversion that's been building up. So it's very directional. I mean, you've got to get your timing right. So the safer way of playing the curve is probably in the 10 to 30 year segment, so favouring a steep steepening, owning the 10s and selling the 30s, for example.
Your base case assumption is the 10-year goes to 2.5, and then 2% into next year?
Yeah, that's our forecast.
How do we get there?
The forecast drops out of the calculation. So, the base case is given to us by the Fed. The base case is 3 to 3.5, because 3 to 3.5 is consistent with the Fed arriving at 5, and then eventually in the next few years coming back down to their equilibrium, which is 2.5, right? So that's how you can get a 3.5. So our 2.5 forecast obviously has a heavy weighting on the left-hand tail that they stop, and the market is preparing for the first cut. Now, I'm not going to sit here and tell you that they're going to cut in 2023, but the probability of rate cuts coming through in 24 and 25 is increasing quite dramatically. And so when you factor all that in, you get a yield moving towards nearer to 2.5 than to 3.5.
Obviously, last month, the big surprise was the BOJ, when all of us didn't expect it, leading into the Christmas holiday. This hawkish pivot. How do you see this all playing out, the ripple effects?
Well, so the question is, was this a curveball? You know what a curveball means, right?
Out of nowhere.
It's sort of, it swerves but goes to the destination. It's a sort of tricky one. Or was it a game changer? Yeah, and it looks more like a curveball. Funny stuff happens in December. It's a good time to bury bad news or to slide something out. And that seems to be what happened here. The hawkish view, the game changer view, extrapolates what happened a year ago with the Fed. When the Fed was tapering at a faster pace, retiring the transitory language, that was the start of the hawkish pivot, as it's become called. So people are saying, well, the BOJ, they've been doing QE for 20 years, this is the start of their hawkish pivot. Well, hang on a second, there's 3 reasons why that isn't true. One, you've got recession risk, including Japan. 2, the spread is really wide between the rest of the world and Japan. So Japan yields moving a little bit isn't that disruptive, to tell you the truth. And the third one is the market's been preparing for this for 3 months. The yen has rallied, 13-14% versus the dollar since October. The curve has been flattening in the long end in Japan. It's not like nobody knew this was going to happen. I know 47 out of 47 economists didn't forecast this, but the market, in its infinite wisdom, has spent the last 3 months saying this might happen. So ultimately, curveball, not game changer.
Right. So when you say this might happen, have we already seen that, or is that a precursor to something that's about to come? Because something that they did was when they adjusted the yield cap, they could sit in that yield cap almost forever because rates are coming down. They don't need to move on rates. I'm just trying to get your view if there's a next step.
David, look, the policy of trying to set a target for the price and the quantity is contradictory, and the whole thing was becoming untenable. Sometime in October, when the intervention was going on for the yen, the Japanese authorities were letting it be known they weren't happy with $150 yen. Right, so the turning point kind of came in October, when we got to sort of the peak for dollar yen and the maximum steepness for the long end of Japanese curve, and the realization that there's no bonds left to buy. So they actually had to do something. So I look at it like that. I actually do believe this was a technical adjustment to buy more time. Markets have been preparing for this for ages. They know that Kuroda's going to retire, most probably. So it seems to me that it's more of a curveball.
I mean, here they are again. I mean, unscheduled bond buying for a third day, and then they're telling us, of course, they have to protect a certain level. Do they need to exit negative rates? Well,
again, it's about timing, and I think they'd like to. But what you want and what you get are 2 different things. Just think about what you got for Christmas. It's probably 2 different things. But it's about timing. If the global economy is mainly in a recession, they've missed it. So they're hoping that they have the chance to get at least above 0 again. But the point for me is, if this had happened 1 year ago, it could have been really disruptive for global fixed income because all yields were compressed on the floor. Right now, you've got the US pushing short rates to 5. You've got the global fixed income market is way away from Japan. So if they do a 10, 15 basis point, we don't care.
Yeah.
Okay.
Okay. Before you go, I have to ask you what the opportunities are. You're focusing a lot on investment grade credit.
Yeah.
Do you think Asia EM can outperform the US this year?
Yeah, actually, Asia IG, so Asia investment grade credit, looks in a really good place right now. You're just looking at the sort of default outlook, looking at the valuation. If we're right on the Treasury call, you want dollar-denominated, Asia IG looks like a really good place to be. So for investors, if you can get 5 to 7% yield, let's not be too greedy.
Right.
Yeah, after the year that we had.
Well, final one, EM local rates.
Yeah.
There's also some value there, but there's also political risk. Like, where would you take advantage of that, and what would you avoid?
Yeah, so LATAM's been the better place, a happier place to be, and I think that continues to be the case. A few countries have become uninvestable because of geopolitical events, so the index has sort of shrunk a little bit from what's investable. So I think China rates still look okay. And if you just think about what happened in 2022, given all of the events, just how stable were Chinese government bonds, that they actually played the role of a safe haven through that period. So again, I don't think much will happen. I don't think yields will move very much through the year.